Paul Marion, President of Tiffin University. I'm pleased to welcome everybody to Good Morning World. This is a speaker series that Tiffin University has provided as a community service for a number of years, and we've had a number of very interesting speakers from the business world, politics, athletics, a variety of speakers, and a lot of interesting input for our community leaders who tend to participate. So we're very pleased that all of you are here this morning. And with that, I will introduce our Vice President for Development and Public Affairs, Ron Schumacher, to introduce our speakers.
Thanks, Dr. Marion. It's a great day here in Tiffin. Welcome to the final installment of 2013 for the Good Morning World Speaker Series. Looking ahead, before we talk about our speakers, for the fall, we already have two speakers that are ready to come in and speak. And just to give you a heads up, Mr. Tom Barnett in September of 2013 will be here. He's a defense analyst. And on October 17th, the quarterback coach to the Stars, former TU alum Mr. George Whitfield, will be here. If you don't recognize George's name, as the NFL draft approaches, keep an eye out on the articles, especially the ones concerning the quarterbacks in the NFL. And George is a TU alum. Today, we'd like to welcome Marguerite. Thank you for being here, former treasurer, and all of you to be here to look with Mr. Avdakov as he looks at projections for the rest of this year. But before I bring him up, Mr. Dave Fisher is here. Mr. Fisher is responsible for the development and acquisition of new business for the department at U.S. Bank as a trust officer, as well as administering personal trusts and serving as the department's financial planner. Dave Fisher joined U.S. Bank in 2003 and has more than 10 years of banking, trust, and estate planning experience. Dave is a graduate of Cedarville University with a BA in marketing. He is currently the membership chair and past secretary of the Dayton CFA Society. And Dave will be introducing Dave, our other speaker. So, Mr. Dave Fisher.
Glad to be here. We came in last night and appreciate the hospitality of Camden Falls and just being here to be a part of the series. As you know, if you saw the invite, I'm not David Avdakov, but I'm here to introduce him. Dave and I have had the pleasure of working together for about 12 years. He and myself and a staff of about 8 others support the U.S. banks in the Western Ohio region with estate planning, financial planning, and an economic outlook. What Dave's going to talk for us today. So I'm going to introduce Dave. He joined the bank in 1999. He came from Harrington Bank out of Richmond, Indiana. Spent most of his time in the western half of the state in college, UD graduate, and earned his master's from Xavier University. After coming to the bank in 2001, Dave received his CFA designation as a chartered financial analyst. And Dave is also currently serving on the board of the CFA Society of Dayton. Along with myself, he was a past president, currently is serving in the role of treasurer. A couple of years ago, Dave was nominated as a top 40 under 40 recipient for the Dayton Business Journal. And today he's going to give you some thoughts on what's going on in the economy and what that means to everyone here. So help me welcome Dave Avdakov.
The trend, I'm not going to go up there. That was a big pop when those guys stepped up there. Thank you, Tiffin University. I love coming back into Tiffin. My wife, she grew up here. She was born here and she graduated from high school. So it's fun for me to come back. Unfortunately, my in-laws moved out, so I don't get to come back as much. So before I get going, it's tradition to start off an event like this with a goofy story, and I believe in tradition. So there was a gentleman, fortunately he passed away, goes up, sees St. Peter at the pearly gates. St. Peter greets him and he says, can you tell me if you've done something selflessly in your life that was rather heroic? The guy thinks for a minute. And he says, well, there's this one time, there's this lady in distress. She was getting picked on by this large group of mean and nasty looking bikers. And so I went out, I looked, I found the biggest, ugliest, toughest looking member of that bike gang. I went up to him, punched him in the face. He had a nose ring, pulled it out, and I yelled, if anybody messes with that young lady, they have to come through me first. St. Pete, he was aghast. He was held back. He said, wow, that is very impressive. And he said, well, how long ago did that happen? The guy looks down at his watch and says, about 3 minutes. So the moral of the story is information needs to be timely. And so hopefully I will give you some timely information today. So if you see me walking around with wires coming out of me, I'm not a robot, I'm just double mic'd. And so I'll have this clicker that I'll be working with. And if I need to take a sip, I guess I'll be juggling a little bit. So you should be thoroughly entertained today. So let me go ahead and get started. And what I'm going to talk about today, a little bit about the economy, what's going on in the marketplace, also what trends do we see going forward that can possibly help your portfolio, and then in the end we'll show you pretty much what we're telling our clients. Okay, let's start it off with the economy. Okay, currently with situations that are going on in Europe, every day you hear all the fun that's going on in Europe. They have this huge imbalance that's going on. They're spending way too much, similar to what's going on in the United States. And let's not leave out Japan. They've been doing this game for the last 20 years. Because of that, today, the global economy is not hitting on all cylinders. We're seeing growth, only about 3/4 of what you'd normally expect it to be. But even with this said, we do think that there are some opportunities out there. Within the United States, if you listen to the news, number one, I feel sorry for you because you're going to be depressed and down. But there's some nice opportunities that are out there. The housing market, my goodness, if you go back to the Great Depression, the housing market during that time period dropped nationally about 33%. This go around nationally, we dropped closer to 35%. So we went through a worse time than they did back then. Now, fortunately, the last 10 months, we've seen the housing market come back up. So that's a positive, and I'll talk about that a little bit. Also, manufacturing is coming back to the United States. We're repatriating jobs. We've not seen that since the early 1990s. And also, we're seeing this in Southeast Ohio, we're fracking. So the energy market. So there's some nice areas that are out there within the U.S. The European zone, that continues to be a mess, if you will. Last year, things were stabilized. In essence, they just whipped out the checkbook and said, we're going to keep this union together. Going forward, one of the sweet spots, and I'll talk about this in a little bit, emerging markets. There are some nice opportunities out there. And you can read it how the economy is bottom. Our economy this year, we might grow about 2%. And it's funny, last year China grew 7%, and we're calling that a bottom because they are growing so rapidly. So what I'd like to do for a moment is talk about the 4 asset areas that we invest in: stocks, bonds, commercial real estate, as well as commodities. Start off with the stock market. If you hear nothing else today besides what I say right now, listen up. Very, very important. Do not fight the Fed. That has been a slogan that's been going on for years, and it is really added where it's don't fight the Fed and friends. Throughout the world, you are having an organized effort where if nations, if their central banks have interest rates to lower, they're lowering them. If they don't, like in the United States, our Fed funds rate is at 0. What they're doing quantitative easing. In essence, they're spewing cash all over the place, trying to get investors to invest in capital. So that bodes very, very well for the stock market. And at the same time, corporate profits are pretty much peaked out. I mean, we are at very close to all-time highs with corporate earnings. Now, the problem that you have in a situation like that, the law of large numbers. So anytime something grows so much, it's hard to keep on growing that. So this year we're looking to see corporate earnings for the S&P 500 to grow somewhere close to 8%. So looking at the stock market, we wouldn't be surprised if we see the S&P 500 from where it is right now to finish up another 60 points. The bond market. The bond market's rather interesting. Its rates stink. If you invest in bonds, it is no fun. If you invest in CDs, it is no fun. There, you get very small yield. Guess what? It's going to stay that way for a while. If anybody has seen the movie Groundhog Day, you could call that the bond market. The reason I say that, 2010, 11, and 12, same thing all over. First part of the year, we saw interest rates rise. Some in the news media get all excited and say, oh, rates are going high. And then the last 8 months of the year, interest rates go back down. We saw this so far this year, and potentially it could be a little bit different because the Fed could possibly stop quantitative easing or back off QE3. That's a potential, and that has a potential to raise interest rates. But with that said, we're probably going to be range bound with the 10-year Treasury. On the low side, let's call it 140. On the high side, potentially 240. Not too exciting there. So next, real estate. With real estate, two completely different areas, residential and commercial. Commercial's actually been doing very, very nicely for the last 4 years. We suspect that it'll continue to do rather well moving forward. One of the main reasons, if you go back to 2006, 67% of Americans owned a home. Back then, you know, Congress was ramping up since 1992, everybody needs a home. And now, roughly about 45% own homes. So guess what? All those people, they went out, they rent now. Over the last 4 years, we've seen rent prices go up, and as a matter of fact, it is more expensive per square foot to rent than it is to own right now. And then I had mentioned with the housing market, we're finally seeing a pickup there, and it is about time, but we still have a long way to go to get back to where we were. And before I go to commodities, last year, top performing asset class, if you include international, was commercial real estate. Worst performing asset class was commodities. And again, this year, commodities continue to underperform. The main reason we put commodities into our clients' portfolio is a hedge against inflation. Because going forward with the economies in India, in China, once they get moving along rather nicely, they're going to control a significant amount of commodity prices. But with the slacks that we're seeing in Europe, that's been keeping commodity prices down. Okay, class participation. Raise your hand if you think we're in a recession right now. Nobody. Raise your hand if it feels like we're in a recession right now. Okay. We want to make sure that you're not all asleep. Thank you for the front table. The next couple slides will explain why. Okay, so we're going to compare and contrast private investment in the United States, the GDP effect, with public or the government. So we have 2001, after the tech bubble, looks a lot like where we're at right now. So not too different. So over that time period, per annum, our economy grew from the private sector right about 3.5%. So we look at the government, and here's where my clients don't believe me. They start throwing rotten fruit at me. Look what happened with government spending. It is down per annum, 1.5%. Now, the reason my clients don't believe me, we see that debt going up and up and up and up, but it's been more at the local areas in the state. States have done a great job at cutting back their expenditures and balancing their budgets. If you go from 2011 to 2012 and take states as an aggregate, they cut spending right about 9%. So we look at economic growth. Currently, we're at an all-time high. The economy has never produced more ever in the United States. The big problem that we have, unemployment, we have this big gap here. A couple factors. Out here, we focused our assets, our resources inappropriately. We had too much in building. And too much in, well, I'm going to say in the finance area, and we'll call it investment banking. So we still have this gap right now. There's a couple reasons for this gap. Number one, the U.S. continues its efficiencies. So once upon a time, a manufacturing job was, use your shoulders, use your back. It's now use your head. Manufacturing, a lot of it is a white-collar job. In addition, the United States now gives you, in essence, 2 years of unemployment. We run into clients where they're trying to hire somebody, and the prospect says, well, I can make just as much from the government doing nothing. So, why not sit on the couch and watch SportsCenter all day long? So if we focus on long-term unemployment, this goes back to Q4 in 2007. You can see the number of nations out there, and then let's fast forward to mid-year last year. Look at the class we're in. Ireland, Spain, the United States, all put together. What this is looking at, the unemployed, percentage-wise, that have been unemployed for more than a year. So that's, again, that goes back to why it feels like the economy is in recession. But the consumers come back. And it's interesting how the consumers come back. Right here, when we went into this huge recession, the consumer went away. Guess what they did? They saved. The savings rate in this country went up to 6.5%. All of a sudden this year, the payroll, give me if you will, that we had the last couple years was taken away. And so the savings rate where we're at right now is only about 2.5%. Okay, so looking at spending as well as disposable income, and then that gap that we have. So spending has come up, but, and I heard somebody, I didn't even pay attention who it was, when they were in the food line, they were saying, oh, that's not that bad, the mutual funds are doing really good. So in essence, people aren't afraid to open up their IRA, their 401k envelope, look at their portfolio, they're actually doing it there. So what's going on here, this differential, there's a wealth effect. Your house has stopped plummeting. Your 401k looks nice. So individuals feel a little bit wealthier and are spending. So this effect that we're seeing over the last couple years, because of the wealth effect, we've actually had a little bit of a pickup from the economy, and we suspect that we'll see that for the next couple of years to come. So survey for home builders, staying along with that theme, confidence is up with new home sales. But there's some macro concerns that still remain. Last year, we had the European Union, the IMF, whip out their checkbook. They call it the Draghi put. In essence, it stabilized the markets, but what it did, it allowed politicians over in Europe to say, we're stabilized. We don't have to make those mean decisions. You know, retirement at 52 is okay. We don't, you know, God forbid if we raise it up to 60. So they're not making those difficult decisions that are out there. China. China grew their economy about 7% last year. First quarter came in at 7.8%. So we're no longer going to see those nice 10, 11, 12% growth in GDP over in China, but still they're going to do quite nicely. Within the United States, we put our pinky toe over the fiscal cliff. Going through sequester, it's not been that bad. But there's still some issues that are out there. The debt ceiling. Are we going to arrive at a budget? These are the unknowns that we face. So what themes and drivers are we looking at? Okay. This is when I take equal opportunity and pick. I don't care if you're a Republican or a Democrat. I want to pick on you both. This is where your party has been fibbing to you. Let's start with the Republicans. Right here, this line right here, revenue that we're getting in from taxes, our tax coffers. On average, we would see as a percent of the economy, revenue coming in close to 18%. Right now it's at 16%. So that's the Republicans' fib. Right up here, spending. We want to have more programs, want to have more social nets. Well, guess what? We're currently spending 24% of our overall economy. Traditionally, it was 20%. So the CEOs that formed a coalition at the latter part of last year have it right. Unfortunately, I don't like higher taxes, but we need to raise revenue. I don't want to put out the date farther of where I can collect Social Security, but people are living longer. It has to happen. And as of right now, neither party is addressing that. Okay. We've been sitting down for a while. You've been very comfortable. I'm going to be mean to you now. I would like, if you would please, everybody to stand up in this room. Okay, so we have this huge pile of debt that we have out there, $16.4 trillion. Again, if you listen to the news, the Chinese own this country. So out of that 16.4, if you think China owns about 10 trillion of that debt, go ahead and have a seat. Nobody, okay? If you think it's closer to 5 trillion, have yourself a seat. Very smart crowd. If it's a little bit less than 2 trillion, go ahead and have a seat. You guys can all sit down now. Smart crowd. So what I'm going to do, a couple different things. Let's talk about who owns this debt. First of all, I alluded to them. Social Security, roughly 5 trillion. Guess what? The trust fund's not going to say we're not going to buy any more bonds, so we don't have to worry from that aspect about buying more bonds because the Social Security will continue to get a pay in, so that's not that big of a worry. Now, if you're my age or younger, you should look at this and say, okay, our percentage, our debt to GDP is 104%. That puts us in rare air. The Spaniards, they have 90%. The Italians, 130. We look at other European brethren that are looking a little bit better. The UK, France, right about, did this go off? I will yell. So the France, the UK, about 70% in my fiscal heroes, the Germans, they only have 50%. So, but the issue that's out there, if our government wanted to get down closer to the French and to the UK, guess where they're cutting? Social Security. So that's one thing to be leery of. Another area, the Fed, quantitative easing. They have been going out purchasing debt. Okay, there we go. They've been purchasing debt, and so that is also on the balance sheet. Now we go and see the remainder. And this has China at 1.2 trillion, Japan at 1.1 trillion. I had a meeting with a Fed representative from Cleveland. More current numbers, it's about 1.6 for the Chinese, 1.3 for the Japanese. So there's sticky money. So when people say people aren't going to buy our treasuries, that's not true. Now, I mentioned quantitative easing. So this is going on throughout the world. The Bank of England, did this die again? You guys need to invest in some batteries here. Okay, so the Bank of England, European Union, even the Japanese their central banks are expanding their balance sheets. So the Japanese, what they've been doing, they have been weakening their yen. First part of the year, it was about 96 yen to a greenback. It's right up to about 97.5. I wouldn't be surprised if we see this go up to about 110. What they're doing, we're having this competition. If you weaken your currency, your exports become cheaper. Japan is a huge exporter. Okay, looking at stocks. So, what opportunities are out there? Number one, for the long haul, and when I say the long haul, it's funny. On the way up here, Dave and I spoke with one of our clients who likes more activity, and so to him, 3 months is the long haul, but we're talking 10 years. When you're investing in stocks, that is the long haul. The emerging markets have some tremendous opportunities and demographics that are out there that I'll share with you in a moment. In the U.S., don't count out America. So what we're looking at here is trailing in the blue bar, trailing economic growth from a number of emerging market nations, and on the right, in the red, expectations for economic growth. Okay, looks rather nice outside of Brazil. Then let's look at the developed nations. Italy and France don't look too exciting. Out of all those developed nations, U.S. looks pretty good, but that differential in growth over the long haul, I would suggest investing some money in equities as well as in bonds in the emerging markets. Okay. With world GDP growth as a percentage, in a couple years, probably about 3 years, the emerging markets will surpass the developed markets. Now, we can actually go back about 3.5 years, and we saw the emerging markets purchase more automobiles than the developed nations. These trends are never going back. Okay, looking at 2009, actually I want to jump back, sorry about that. Looking at 2009, the middle class, overall throughout the globe, a component of GDP spending, we see North America, Europe, and Asia. And then we see expectations 20 years down the road, Asia will have a dominant middle class. So again, all reasons to invest. But as I said, don't count out America. We have some nice opportunities here. 3 is a charm, I hope. Okay, can you hear? Oh, there we go. See how long these batteries last. In the US, in the year 2000, our energy reliance was 28% from foreigners. A couple years back, 21%. By 2020, about 13%. And there is no reason, if we're smart and responsible, that we're not energy independent, say 10 years down the road. So we look at natural gas production and you look at the red and the burnt orange, whatever you want to call it, and that's from fracking. That's an advantage that we have. And so that is keeping natural gas prices down. Now with this slide, this has nothing to do with fracking. It has everything to do with a global collapse financially. Over here to the right, that does have a good bit to do with the US increasing their energy output. So if we look around the globe, look at liquefied gas, we find we're, in North America, we're the cheap producer. Let's call it $4 on average. Let's compare it to the Chinese at 15. The Chinese, they have shale. Problem is they don't have the water. In Eastern Europe, you have the Czech and Slovak area, same scenario, they don't have the infrastructure. That is a huge advantage for the United States. One of the reasons why manufacturing has come back. So let's stay on that theme with manufacturing. Okay, the cost of energy is cheaper here. So we're seeing companies that are repatriating jobs back from foreign nations. But something else is going on in manufacturing. I'll share with you 2 scenarios. Number 1, if I have a product that needs value added, you get more value by manufacturing in the United States. If I have a problem, let's say I'm in, pick on Cincinnati, and my producer is over in Akron. Well, heck, I can drive up, meet with the facility, iron out any problems. I come back, I can go and watch my kids play baseball that evening, and it's great. Same situation with China. I fly all the way over to China. My problems still might not be resolved. The quality necessarily isn't as high. And then it takes so long to go back and forth. That's one area. Another area, the Chinese, their salaries have been going up 20–25% per annum. In the United States, salaries, if you're lucky to get a raise, maybe 2%. So the US is definitely competitive again in manufacturing. So looking out at the long haul, definitely we feel that there's opportunity in emerging markets. Now in full disclosure, again, I state long haul. Last year, we saw a lot of volatility in emerging markets. They finished up nicely at the end of the year. Currently, they're significantly lagging developed foreign, which is lagging the domestic market. Okay, looking at the developed nations, they still have their financial fiscal issues, if you want to call it that. But we would say you still want to take a peek. And it's, you know, it's not fair lumping together the Eurozone completely together. It's the North and it's the South. You look at Norway, Finland, Sweden, Switzerland, Germany. Germany's stock market was up 29% last year. Ours was up about 16%. It's those southern peripheral nations to worry about. And those opportunities that exist that I told you about with the housing market increasing, that increase in wealth feeling, manufacturing as well as energy. So let's go ahead and focus on bonds. Okay. I already told you the groundhog story, so the media knows this. And they're saying, okay, interest rates are scary, don't buy bonds. And full disclosure, we're underweighted in bonds, but for the next couple of years, I would be surprised if the Fed raises interest rates. There's too many slacks out there. So I wouldn't be afraid of this chart. I would just say that know it. Yes, interest rates will eventually go up. When they do, the Fed will probably take Fed funds rates up to, let's say, 3%. Again, the Fed is very fearful of inflation and deflation. Okay, so what will cause rates to go up? The Chinese not buying our bonds anymore. That's not going to happen. Inflation jumping up. We're not seeing that. We don't think that we'll have that anytime soon. The Fed cutting off quantitative easing later this year could happen, but by then we'll show you a slide, and it's not too big of a concern. So again, let's pick on China a little bit. Okay, so what we have here, we have a couple nations out there. The bottom portion is you can see the bottom darker portion is what foreigners own. So if you do not, if you want to pull out some of this, where are you going to put it? Japan. Yes?
On that last slide, when you talk about interest rates going up, I think our biggest concern is that interest rates may not go up on the short end of the curve for a couple of years. But the long end of the curve is driven not necessarily by the Fed funds rate, it's driven by everything. And we've already seen that long end start to creep. So short-term bonds seem to be okay, but aren't you concerned about long-term bonds?
Long-term, excellent question. Long-term bonds, when interest rates rise, you will lose more money. So what we're looking at right now with our clients, we would look to be in the intermediate range, if you would. The sweet spot of the curve, as far as we're concerned, is out 5 to 11 years. You get a little pickup in yield because of the steepness. But you can back up and look at Japan. It's been a 20-year run. Their rates are lower than ours. So a lot of this has to do with not the Fed, with Congress and the President. The Fed, they're bullets. I mean, they're shooting, let's call them blanks. They're not that bad, but right now, it's close to that. The real decisions have to be made on the governing side, what we're going to do with our fiscal imbalance. So that'll definitely play more into that. But if we continue to see all these slacks out there, we could go through a long, long period of time where interest rates remain very low. The Fed, with Ben Bernanke, they've been open. With Greenspan, you had to get 6 interpreters just to figure out what he was saying. Bernanke's wide open. So that is a positive. But no, when rates rise, the long end will definitely be hit more. Okay, back to the China quandary. So with Japan, it's almost impossible to become a citizen there if you're from the outside. And their debt to GDP is a lot worse than ours, so that's a tough spot to invest in. The other day, I met with a board, and I said, so what do you guys think of investing in the euro market? He shook his head emphatically. UK, not that bad. Great places to invest. Switzerland, Canada, Australia. There's not enough debt out there to invest. So for the time being, the U.S. is in a good sweet spot now. I'm going to give a little shout out to Adam Scott here, who just won the Masters. So who knows, because the party that they're having in Australia this week, we might see that debt go up a little bit, but not too much. So going back to that comment that I was talking about with no inflation in sight, two big components, and I'll actually add a third one in, wages, home prices. Now home prices have come up, but they have a long way to go to get back to where they were. Wages, unemployment, 7.7%. The employee does not have that much leverage. And then, you know, we say, oh, it's great, unemployment's coming down. But look at the participation rate. There's only 63.3% of Americans that are trying to get a job right now that are out there. That's the worst in 30 years. And another one that I'll add, our capacity utilization right now is about 79%. We could go all the way up to 85% before we need a build out, which could become inflationary. Okay, I talked a little bit about quantitative easing in the Fed. Okay, here we go. So if the Fed would come out today, it's the second quarter, oops. There we go. And say that we're going to stop QE3, we would see, it's our estimate that we would see the 10-year Treasury bump up 35 basis points. That might seem like a lot, but again, in 2-3 weeks, we've seen the 10-year Treasury go from about 205 down to 170. The first part of the year, it was closer to 155 and it jumped up. So that really doesn't excite me too much. If the Fed decides to ease off quantitative easing, it's probably going to be here if they stop it entirely, and you're not going to have that much of a shock. So it's based on expectations. If you expect it, it's not that bad. So with fixed income, the big takeaway, people are not going to stop buying U.S. debt. Part of it is because all the problems that are going on in Europe. With the Fed, it says, you know, they're going to hold rates. Hang on it. Sensitive little clicker. The Fed, it's going to hold rates still on the short end from 2013. I'll throw that out there to mid-year 2015. And the Fed sort of switched because they kept giving dates. Originally they said we'll raise it 2012, then 2013, and those dates have come and gone. So they said, let's change the rules of the game. Once unemployment gets down to 6.5%, then we'll change. So that's one thing to look for. So what are we investing in bond land? We're running away from treasuries, mortgage-backed securities that are interest rate sensitive. Again, going back to my comment, about 5 to 11 years, because we think we get a pass for the next, let's call it 2-3 years. And then wherever you buy along the spectrum, credit-wise, we are buying premiums. The other day, I bought a bond that was priced at a premium of 118. Before, when interest rates were more normal, I would gag at a premium over the 107, but those days are gone. Okay, the first rule of investing is that if something looks too good to be true, it probably is. The second rule of investing is the Fed can suspend the first rule, and we're seeing this right now. So with quantitative easing, first of all, let me back up because we hear all the time quantitative easing, quantitative easing. Some people might not know what that is. So the Fed would, to stimulate the economy, would lower interest rates. Then at the end of 2008, they had no interest rates. We had a liquidity crisis, quantitative easing, they bought some bonds. You buy bonds, you put cash out into the marketplace. the liquidity crisis went away. Genius move. QE2. As I said before, the Fed is very fearful of deflation. At that point in time, the CPI was only at 0.6. They were very fearful. Economy slowing down. Let's buy some more bonds. Operation Twist. We sell short-term bonds, go and buy long-term bonds. Artificially, and all this is artificial, keeping interest rates down low. QE3. It was interesting. QE3, I'm not a fan of QE3. It's really hasn't done much for the economy. And it was interesting. Had a representative from the Cleveland Fed give a presentation afterwards. I had a one-on-one with him, and I asked him that question. And off the record, I'm not going to share his name with you, he said he agreed with me. You know, why have that? But forget that for a moment. Look what happened. The Fed created all this liquidity, stock market goes up. Again it goes up, again it goes up. And we continue to see that. So currently, if you look at our 4 asset classes that we look at, we're overweighted in stocks, underweighted in bonds, pretty much neutral in commodities and real estate. And a couple years back, pretty much what we did a little bit, we stole from this area and added to commercial real estate. So with the globe as a whole, a little bit muted growth, but we do expect it to pick up later this year. You look throughout developed nations, the United States, where we continue to slowly meander our economy along, where there are some European nations that are in a slight recession. The US, as we alluded to, doing okay, even though we have some fiscal issues. And then lastly, for the long haul, emerging markets, we think that they've hit the bottom in their economic cycle and that there are some good opportunities out there. So with that, I will take on any questions.
What's the perception of the way the market reacts to something like the other day where the Boston Marathon bombing? It's always seemed very irrational to me that the market would crash the way it does in a way that doesn't make sense.
Sure. There's a couple issues that are out there. Institutional investors like us, we move very, very slowly. If we're going to make a change in our asset allocation, we'll probably move at 5%. But number one, you have flash trading, which quite personally, I think it should be illegal and it serves no purposes. The markets will say that it creates liquidity and it can create some havoc. But part of that is triggered through that, and it is a fear. It's like, okay, what happens? You go back to 9/11. You have something that started in one area and it continued. So it's a trigger, and you hit it right on the head. It's irrational. You have small nations in Europe that they have issues. You know, who cares about Greece? Why do we care about Greece? And the main reason is what got us into trouble in 2008, all these derivatives out there. I'll give you an example. Greece, they have all this terrible debt out there, even though, you know, Draghi whipped out his checkbook last year. And who cares about that? Well, the French, all these French banks, they own a bunch of Greek debt. So why does that affect the US stock market? Well, what you have, a number of investment banks, what they've done, they sell insurance, if you will, credit default swaps. And what they do, it's like insurance, so if nothing happens to Greek bonds, the US investment banks, they collect a continuous premium, so they're happy there. But if something goes awry, and let's say the Greeks one day say, you know, we're only going to pay 50 cents on the dollar, then the US investment banks, they have to pay that differential. So that's, you know, once upon a time the world was flat, then it became round. The world's flat again. So we're still interwoven, and that's an issue. We had an opportunity, you know, don't waste a crisis. We wasted a crisis. We had one of the best pieces of legislation ever passed in this country. Glass-Steagall, what they did, they separated investment banks from commercial banks. Worked great for 63 years. Then they got rid of it, and 9 years later, there's a huge mushroom cloud. So what does the government do? They don't put it back in. So a number of relating factors, and it all goes back to we are so interwoven, small nations, that we end up having our banks having contracts with can create problems, and along with a lot of flash trading. So hopefully that answered your question. Any other questions? Yes, ma'am.
So when we talk about the currencies and devaluation, if the United States continues to try to keep their currencies low, what does that mean? What are you guys talking about the price of gold? Because we've heard 1,200.
With gold, I'm not a gold expert. I don't play one on TV, but with gold, if the U.S. economy moves along nicely, one would expect gold prices to go down. So that's definitely very possible there. So it's more based on expectations. You look at gold. This last week, we saw the biggest hit in about 30 years. If you go back, and people have short-term memories, 1979, you had gold about $900 an ounce, and in the mid-80s, it was selling, late 80s, it was selling about $250. And now you have all these commercials on CNBC, Bloomberg Television, pretty much saying, if you want safe, secure investment, buy gold. If you don't have gold, you're an idiot. Well, there's no problem with having gold as a part of a diversified portfolio, but to sell out. And it's interesting because I have a couple of clients that want to carry this big gold nugget around with them, and it's like, well, what happens if you're driving home and somebody just pulls out a gun? Too bad, so sad. But no, so I would say it's more based on outlook. The more stability you have, the worse you'd expect gold to perform. So that wouldn't surprise me if we see a little bit more ease off in gold. Any other questions? Yes, sir.
Why do we as taxpayers have to bail out banks like yours and other businesses? Awesome
question. U.S. Bank, we took TARP money. We did, about $4.5 trillion. We had Hank Paulson call up our CEO on a weekend, said, how much you want? Don't need any, don't want any. And he says pretty much he wasn't getting off the telephone until he took that money. We ended up taking it. We were in the first group that paid off, and the U.S. economy, or the U.S. government made about $175 million off of us. The reason that they had a bailout, if we didn't come up with TARP, the Great Depression would have looked like a cakewalk. AIG, an insurance company, a huge insurance company, when I was talking about these contracts where they go and they cover default swaps, they had a bunch of them. They didn't have the capital for them. So it was a scenario where the whole economy would have collapsed. Do I agree with it? If we didn't have TARP, we would be in a depression right now. Now, could we change things too big to fail? Quite frankly, in my opinion, there's no such thing as too big to fail. Look to the north. Canada has 9 banks. They're not too big to fail. They did not have investment banks that were trying to, if I work for an investment bank and I take on risky assets, I can make a nice bonus in a quarter. If the bank goes under, well, it got bailed out. So I would say get rid of that behavior. You look through every crisis, people go to jail. There's not too many people in jail. So when companies, and this is companies throughout the U.S., when they're allowed to pay any amount to a politician, you know, call it what you want. I mean, it's funny. You can go to a politician and say, here's the satchel of 100, well, let's pick a big number, $1 million. He looks at you and said, I can't do that. That's bribery. That's legal. But my son's a lobbyist. Go give that money to him. So that's, there's some issues out there, again, going back to my comment, where we wasted a crisis. Should we have gone back and changed some laws that would have affected that? I think that would. But that's why you had TARP come about. And you can even go back farther than that. Hank Paulson, the then treasurer, he let Lehman Brothers go under. And it was very interesting what happened with Lehman Brothers. A half a year prior, Bear Stearns was in the same scenario. They were going under. There was a deal that was done that was backed by the government. And so they were taken care of by JP Morgan. Fast forward to September of '08. Lehman Brothers was allowed to go under. What was set up, and it's very interesting, what was set up, all these banks came together and they were going to chip in billions of dollars. And Lehman Brothers would have survived. But they were going to be bought out by Barclays, an English bank. I believe it's called the FSA, the equivalent of the SEC here. At the last moment said no. They went back, they wouldn't approve the deal because they either wanted a guarantee from the US government, which they wouldn't get, or they wanted their shareholders to vote on that. So in essence, Barclays got a sweet deal and we ended up with TARP. But I agree that going forward, that's crazy because a number, especially investment banks, the auto industry, they got a bailout. The homeowner did not get a bailout. The unemployed, the 7.7%, if you look at U6, that includes people that have stopped looking, that includes people that are underemployed, that's closer to 13%. So that's where Congress should come in and set some regulation there. Part of it they've done a little bit with better capitalization, but there's still a long way to go. Yes? Okay, I'm done. Yeah. Thank you.
Let's hear it for Dave.
I'll grab this.
Talking about the economy and all the things we've faced over the last several years, and doing it with brevity and levity is just great. And Dave and Joanne, you'll be here to answer any further questions that people have. Okay, just in case you guys had other questions. I want to thank US Bank. I want to thank Joanne, the two Daves that are in attendance today, Dave Fisher, David Avdakov, as well as one who's not here, Dave Shelton. When I spoke to Dave earlier this year, Dave was very willing to assist us in finding a speaker, a very timely speaker, and very good information. I need to thank Camden Falls, Adam, and staff here. Thanks for everything that they do. Lori and Sandy, the staff in the development office, John, Colleen, Celinda, and Jason running around trying to find batteries. Thank you. We look forward to next fall. As I said in the beginning, speakers set up in September and October. I just want to thank you guys for being here today. Go out and enjoy the weather. Take care.